Good afternoon, everyone. Welcome to our blockchain special interest group webinar this afternoon with John Singh and myself. I am here to introduce John to you all. John Singh is a senior SAP consultant at VMG Labs and has been involved in software design and development for over 20 years. He's also currently the vice chairman of the IITPSA board and the chairman of our REMCO committee. So John has been working with the Blockchain SIG since 2019. He's passionate about presenting about blockchain in simple, understandable ways that us people who are not very familiar with blockchain can understand. So with that short introduction, I'll give it to you, John, to take it away. Thank you.
Thank you, Calvin, for the very kind introduction, and welcome to everyone that joined the presentation. So as Calvin mentioned, this is a blockchain special interest group presentation. The topic is Bitcoin Improvement Proposal 54, which is the consensus cleanup. And the idea behind this consensus cleanup is to try and rectify some of the vulnerabilities in the Bitcoin protocol. Now, that sounds quite scary because Bitcoin is quite a massive financial system with many billions of dollars in assets. So, it seems quite scary that there's vulnerabilities, but these vulnerabilities are quite difficult to exploit. It would take a great deal of knowledge of the technology, and also quite a number of resources in terms of computing power and money in order to achieve cracking into these vulnerabilities. So in this presentation, we'll go through the vulnerabilities and explain them, and also get a bit more understanding of the underlying mechanisms of the Bitcoin technology. And in table of contents, we will go through some of the fundamentals of Bitcoin technology. So a few minutes, because a lot of understanding these vulnerabilities needs a bit of technical understanding. So we'll go through some of that, and then we'll look at the Timewarp attack, the hard to validate blocks, and then forging confirmed transactions and the duplicate coin-based transactions. And then we'll have conclusion and final thoughts. So as many of you know, Bitcoin has certain technological fundamentals. So in terms of initiating transactions, these are people on the Bitcoin network that will initiate transactions either by buying or selling Bitcoin, either on an exchange or peer-to-peer between two different people, or buying some kind of item from an online store or a brick and mortar store. And these transactions are then sent to nodes on the network. So a node is any hardware that is running the Bitcoin core software. So once these transactions are sent out, they are broadcast across the network, they are validated, and then the process of putting transactions into blocks start happening. And then you have special nodes called miners, and these miners are responsible for doing the proof of work cryptographic puzzle solving. And once they solve the cryptographic puzzle, they have the right to put the transactions in the blocks, and they can distribute to the rest of the network, which will update their local copy of the blockchain. So most nodes will have a local copy of the blockchain, and they update them from verified blocks that have been given to them by miners. And that, in a nutshell, is the decentralized process. So remember, it's decentralized, peer-to-peer, and most nodes have a full copy of the blockchain. In terms of distributed consensus, so this is the mechanism whereby the entire network gets into sync, because each of them have their own copy. So it needs to be in sync eventually. So it's not an immediate process, it's an eventual process. So what happens is that You have independent verification of transactions by each node, then the independent creation of blocks by miners, and miners will then go into the proof of work process, and eventually the winner will do the block validation, and then the nodes will receive them, and then there's block validation by each node and assembly into a chain. And there's independent selection of the chain with the most cumulative computation. When it comes to verifying transactions, there are a number of checks that take place, and this helps in making sure that only valid transactions are transmitted on the network, and it helps improve security as well. So it's always checked that the transaction syntax and data structure are correct, and then the lists of inputs and outputs cannot be empty. The size of the transaction in bytes is less than the maximum block size. So a single transaction can't be bigger than the actual size of the block. And then the transaction size in bytes is greater than or equal to 100, so that we know there is some well-formed and well-structured transaction. The Coinbase output must have at least 100 confirmations. So the Coinbase output, that's the special transaction that is used to identify the rewards that will be given to the miner. So it's the first transaction in the block, and it has the address of the miner that has solved the proof of work puzzle. Then a matching transaction in the pool or a block must exist. So for each input, the reference output exists and is not already spent. It's rejected if the sum of the input values is less than the sum of the output values, and it is rejected if the transaction would be too low to get into an empty block. So it can't be too, the value of the transaction can't be too low. So once the miners have received the transaction, they validate them, they put them into an unspent transaction pool, and they start assembling them into blocks. So a block header itself is made up of these fields, a version number, and then a previous block hash. So this is quite important, because this is where the whole idea of a blockchain comes from, is because each block has a reference to the previous block, and it's an unbreakable, immutable kind of reference to the other block. And then there's a Merkle root. So Merkle root, we'll talk about it a little bit later, but it's a very clever way of storing a summary of the transactions on the header, so that you have a reduced space, and all you have is one basic root value in there, instead of a whole bunch of transactions that need to be referenced. So then there's a timestamp, that's the approximate creation time of the block. So it's approximate because there are various time zones, etc. So it's difficult sometimes to really get a final and true version of a timestamp, but they are stamped onto the block, and then it's taken from there. And then there's a target, which is the proof of work algorithm target for the block, and then a nonce, which is a counter. So it's using the proof of work algorithm, and the counter is incremented each time in the hashing mechanism, so you get a unique hash each time. In terms of the block timestamp, this is important because to ensure that the block time keeps moving forward, there are a few rules. The first is the medium past time rule. So the timestamp must be further forwards than the medium of the last 11 blocks. And then there's the future block time rule. So the timestamp cannot be more than 2 hours in the future, so relative to the median time from the node's peers. So this ensures that the timestamp is always moving forward, and that it's always kept on track. In terms of the mining process, this is a very computationally intensive process. So the miners will take the contents of the block, and they'll use a hashing algorithm called the secure hash algorithms, 256 bits. and they repeatedly apply the hash algorithm on the block header. They check if the hash is less than the target on the header, and if it is, then the proof of work has been solved. If it isn't, then the nonce value is incremented by 1, and the entire block is then hashed again. So this is a very time-consuming brute force method to find a hash that is less than the target. So it's very computationally expensive, and it takes a long time to do. So it's not easy to carry out the mining process, but the miners generally have hardware that can handle this computationally intensive proof of work puzzle. So let's look at Merkle trees. So if you remember, the Merkle root is stored on the block of the header. So if you have, for example, 4 transactions, which is a very simplistic example, right? It would firstly be hashed, and you'd have the hash of transaction A, transaction B, C, and D. And then these leaves would then be hashed into a parent node. So hash of A and B is the hash of transaction A and B, and then the next the parent would be the hash of transaction C and D. And then finally, right at the top level, you'd hash all 4 of these transaction hashes together, and you get one Merkle root, which encompasses all these transactions into one single hash, which is a very computationally unique way of storing it, and also makes it very efficient to find a transaction just by looking at this root hash. And it's important when it comes to payment verifiers that don't have a full blockchain available. So they just download the header of the blockchain, and they use the Merkle root to try and identify if their transaction is on that particular block. So this brings us to the SPV nodes. So these are the simplified payment verification nodes that operate without a full blockchain. So SPV nodes only download the block headers without transactions, and it's about 1,000 times smaller than a full blockchain. So an SPV will verify the chain of all the blocks and link the chain to the transaction of interest using the Merkle path. So it uses that Merkle root to try and verify whether the transaction it's looking at is in there. Let's look at a simple payment transaction just so that we understand very briefly how the payments work. So in this example here, there's a fictitious person called Jack that bought something from a store owner called Temba. So Temba will have to produce a full public key and a public key hash, which he passes on to Jack's mobile. So he has a copy of the public key hash, and this is put on the transaction output. So only a person that has a digital signature that also matches to this public key hash will be able to spend that transaction output. So we look at this a little bit more closely. So in terms of Temba, so he will have a signature. So the signature is a elliptical curve digital signature algorithm crypto formula that combines the transaction data with the private key. He also has a full public key, and this will be used to unlock the transaction output. So the inputs with the signature and the full public key is used to unlock the public key hash on the transaction output, which is basically the Bitcoin that is required to be spent. If we look at the payment mechanism, it uses scripts. So one of the popular ones is the pay to public key hash script. So as mentioned, you have an input, which is made up of this a signature and a public key hash. So this is the unlock script. And then the actual Bitcoin to be spent is in an output transaction. And this is made up of a number of operation codes So if you look on the left, you see something called dupe, which means duplicate. Then apply hash 160 means apply the hash 160 algorithm. Then you compare that to the public key hash sent by the sent with the input, and if they equal, then you go into the check signature operation code, which checks that the signature sent on the input is this has the same origin as the public key that was also included here. So they both use the same private key. That's how Bitcoin outputs are unlocked for spending. And then lastly, look very quickly at blockchain forks, because as part of the mechanism, it's always in a state of change, because you have all these independent blockchains sitting in nodes, so they have to be kept in sync. So what we see on screen at the moment is a blockchain network that is perfectly in sync. So all of them have a star, which means they all have the same structure, and the star block is pointing to the same. All of them are pointing exactly the same to the prior block. But what happens is that inevitably there will be mining taking place. So in the next example, we see that there's two miners, node Y and node X, and they both solve the cryptographic proof of work puzzle at the same time. And so they assemble their block into the chain, and suddenly you have a network that's in a state of disagreement, because now you have one half of it which sees the upside down triangle as the longest chain, and another half which sees the white triangle as the longest chain. And this is resolved in the next proof of work race, because in the next proof of work, node Z will find the proof of work puzzle and solve it, and suddenly produces this block, which is a green diamond, and each node in the network will accept this block, and this will now be the longest chain, and the entire network is back in equilibrium. You can see the upside down red triangle was a block that was sent out, but now it's sitting on an alternate fork, and it'll eventually be discarded because it'll fall away from the longest chain that is starting to form again. Okay, so now we can finally get down to the real content of the presentation, which is explaining the vulnerabilities in Bitcoin, right? So the first vulnerability is the Timewarp attack. So it's an exploit of Bitcoin's difficulty adjustment that allows miners controlling a large amount of hash rate to increase how fast blocks are mined. So by doing this, they're able to take control of a greater portion of the mining capacity, and thus earn more money, and in a way cheating the system, because it allows them to now earn more Bitcoin. So the reason for this vulnerability is because Bitcoin adjusts mining difficulty every 2016 blocks, and it tries to maintain an average of 10 minutes per block. However, the difficulty adjustment compares the timestamps for the first and last block of a period, a span that covers only 215 block intervals. And the problem there is that the actual timing is meant for 2016 blocks, but it physically only spans 215 block intervals. So to prevent this, the change that was recommended was to requiring a minimum timestamp for the first block in the difficulty period based on the timestamp of its predecessor, the last block of the prior difficulty period, and that solves this Timewarp attack. So to explain a little bit more, in the original Bitcoin core code written by Satoshi Nakamoto, the window of 2016 blocks contains 215 intervals between the blocks. So that's 2016 minus 1. So the relevant target time should be 60 seconds times 10 minutes times 2015 intervals, which is 1,209,000 seconds. However, the protocol itself uses the number 2016 to calculate the target, and results in a interval of 1,209,600,000 seconds, and that provides room for exploiting. And so the first block of the difficulty adjustment period is different from the last block of the previous periods. So miners can exploit this by setting the timestamp of the last block in each difficulty period to the maximum allowed value, which is up to 2 hours in the future. And then they set the timestamp of the first block of the next period to the minimum allowed value, constrained only by the medium time pass, which is the medium of the last 11 blocks. By doing that, they can manipulate the difficulty adjustment period and try to manipulate it so that they can gain more rewards. But it's a very difficult vulnerability to exploit. You need a lot of computing power and control of the network. So it has to be a miner with a very large amount of control of the network. So the fix prevents the time of attacks by acquiring a minimum timestamp on the first block and also on the next block of the difficulty period. And there's also a restriction on shifting the start of the difficulty period, and so that can't be manipulated. So the fix also includes a 2-hour grace period and after each difficulty adjustment to accommodate natural timestamp variation. So this fix will eventually solve this problem here. The next vulnerability is the hard to validate blocks. So attacker can create poison blocks that take more than an hour to verify, resulting in various denial of service attacks. So legacy Bitcoin transactions can be specially crafted to increase their validation times. So various techniques can be used to exploit resource usage limits in the validation of a Bitcoin pre-SIG script. So BIP54 tries to solve this by having a per transaction limit of 2,500 legacy operations, and this fix reduces the worst case block validation time by 40 times while minimizing the risk of confiscating coins locked in unusual legacy scripts. So if we look at the consensus limit, so the block size limit is 1 megabyte. The size of the scripts to unlock and the locking scripts can be the maximum of 10 kilobytes, and the opcodes per script, there can be the most 201 opcodes per script. So when trying to exploit this vulnerability, the attacker creates many outputs with the check signature operation included 200 times. The attack transaction spends all these outputs as inputs. Each input could have one valid check sig and 200 dummy check sigs padded to make the 10 kilobyte limit. So then you have a huge total amount of data to be hashed. And if you look at this particular graph here, it shows that there's an exponential rise in the size of the transaction to be hashed. So as you add the amount of operations, the check sig operations, and it starts increasing, you can go up to a size of 30 to 40 gigabytes, and if a node had to try and process and hash this, it would take an extremely long time. And this is how it can really slow down the network by doing this kind of manipulation of the transactions. So the next vulnerability is forging confirmed transactions. So a carefully constructed transaction can trick SPV, which is the simplified payment verifying nodes. So remember, these nodes only download headers. They don't have the full blockchain. So this particular vulnerability fools them into accepting what looks like a transaction that's part of the most proof of work chain. So the Bitcoin Merkle tree implementation has a flaw in that a 64-byte transaction has exactly the same size as an internal Merkle tree node. So to solve this, BIP54 makes all 64-bit transactions invalid at the consensus level. So you can't make a 64-bit transaction anymore. So this prevents anyone from creating transactions that could be confused with internal Merkle tree nodes. So if we look at the diagram here, you can see there's a dummy transaction, which is made up with a payment of 1,000 Bitcoin. There's also a real transaction, and you're going to try and fool someone into believing that you're paying them 1,000 Bitcoin, but instead you are not, because you're going to give them a transaction code that is not actually real on the network, right? You're going to fool them into thinking that this real transaction is actually this dummy that they've created. And the way they do that is the attacker creates a real valid Bitcoin transaction, which is exactly 64 bytes in size. The 64-bit size excludes segregated witness. The attacker creates a invalid Bitcoin transaction, sending 1,000 Bitcoin to the victim. The attacker then has a change address for the fake Bitcoin input transaction, and using brute force, the attacker grinds through different change addresses until the 32-byte transaction ID for the fake transaction collides exactly with the last 32 bytes of the real 64-byte transaction. And by doing this, once it's downloaded to the SPV node, it starts believing that this fake transaction is the real transaction, which is not true, and that fools the node into thinking that the payment was sent. But it's a very sophisticated transaction. You can see you have to grind through and try to find a 32-bit hash, which is computationally expensive. The other point is that it's only feasible because you have to spend a lot of money on hardware and computing power and electricity. So only if you're trying to fake this for a very large amount of Bitcoin, like valued to millions of dollars, will this be feasible to do this kind of attack? The last vulnerability is the duplicate transactions. So Bitcoin's consensus rules use transaction IDs to uniquely identify transactions. So duplicate transactions can cause unwanted behavior, including loss of funds. So in Bitcoin's early history, identical coin-based transactions were mined in two separate pairs of blocks. So when the second block was mined, the unspent transaction output from the first block was destroyed. The coins became unspendable because the unspent transaction output database only keeps one entry per transaction ID. So BIP54 solves this by requiring coin-based transactions to set the n-log time to the block height -1. Since n-log time is currently unused in coin-based transactions, this adds uniqueness without disrupting existing users. So by having this value on the transaction, it allows the transaction ID that is generated to be unique. So if we look at the details, these are the transactions that were duplicated in 2010. It only happened once, and it's because they were all going to the same output addresses and just happened to be all the same amount, and then hence the same transaction IDs were generated. If we look at the coin-based structure, you can see it has a transaction hash, an output index that specifies the address that the funds will go to, the coin-based data size, and the sequence number. So, and at the time it was possible to actually have these duplicate transactions because the output indexes were virtually the same, because it was going to the same addresses, and that's why the transaction hash was the same in the pairs of transactions that we saw prior to this. But however, this particular exploitation won't happen again, and because they will be introducing uniqueness into this Coinbase structure. So in conclusion, so BIP54 focuses on cleaning up old design weaknesses that have existed for more than a decade. So, but it's important to know that exploiting those vulnerabilities would be very difficult. So it requires a very sophisticated attack to sometimes exploit them, and also a lot of financial resources and computational resources. However, what it does show there is the important shift towards proactive maintenance of consensus rules. So typically in the Bitcoin environment, change is very slow because you have to get agreement amongst many parties, including developers, miners, and all kinds of people involved in the network, because if it's not accepted by the network, it's very difficult to get changes across. So it typically takes a long time, but in this case, we're seeing a more proactive approach. The implementation is currently being tested in Bitcoin Inquisition, which is a tested node, and the testing is progressing, and they're testing the proposed soft fork in the Signet networks. And so changes do take a long time in Bitcoin, but I think we're starting to see an improvement where they're proactively starting to manage some of these vulnerabilities, even though they are hard to actually exploit. So that is the end of the presentation. I know there was quite a bit of detail, but Bitcoin technology is quite complex sometimes, so it can be a little bit difficult, but I'm very hopeful that the audience was able to get some of the meaning behind some of these vulnerabilities. And I just like to emphasize again that these vulnerabilities are not do not mean that Bitcoin is exposed in any way. It just means that people have seen that there are ways to exploit it, but it is very difficult for anyone to try and actually exploit these vulnerabilities. So I'd like to thank everyone for your attention, and I think we can take questions if there are any.
I do not see any questions in the Q&A, so I think we can take questions in the chat, or I think if you have, can you see your request to speak? I think it's, so there's something there. We are quite a nice group.
There is a question from there is one question.
Yes.
I'll just read it out.
Yes.
Okay. So
yes.
The question is, doesn't the availability and scalability and ease of access to cloud infrastructure make it very simple to perform such an attack quickly? That is a good question. I think so when we talk about the computational resources involved in these kind of exploits, firstly, you need a high level of technical knowledge. The second is, possibly a huge amount of resources in terms of, and these are typically miners have these kind of resources. At the same time, miners don't have a interest in actually trying to exploit the network because they do rely on it for income and profitability. So again, it goes back to game theory, which says that bad actors and good actors, they all work together because it's not in anyone's interest to actually bring this network down. So even though you do have availability and scalability in the cloud, it's not in anyone's interest to actually try and make a use of it. The second thing is that, when it comes to mining operations and large-scale mining operations, they normally they have these large mining farms, if you can call it, which consists of very specific kind of hardware infrastructure called ASICs. So they're not your typical cloud-based infrastructure. It's basically, a very stripped down, efficient hardware-based technology that's used specifically for mining. So yes, even though they have scalability, their specific purpose is for mining and not anything else. So they wouldn't necessarily be used for exploiting kind of vulnerabilities like this. Yeah. So I hope that answers the question.
Okay. Do we have any more questions? John, I think we have no more questions.
Yeah, thank you. I'd just like to thank the audience again, and thank you to Calvin for hosting the session and making sure that I keep in line. Thank you.
No, I enjoyed it. It's above my head, but it's very, very interesting because you explain it so well. So I'm sure the audience enjoyed it as well. Thanks to everyone for attending and going through with us in this last 40 minutes, 42 minutes. If there's no other questions or any closing remarks, John, we can close. Yeah, up to you.
Yeah.
Thank you very much.
Yeah, we can close. Yeah.
All right. Okay, so thank you, everyone. Have a good evening.
Thanks, everyone. Bye-bye.